Welcome to our Vanguard Super Learn Series. Today, we're diving into the basics of superannuation. Whether you're just starting your super investing journey or looking to build your super knowledge, Vanguard Super is here to help. Simply put, superannuation is your long-term savings plan for retirement. It's money set aside during your working life, invested to grow, and eventually used to fund your retirement from a pension account that pays you a regular income. One of the great advantages of the super system is the built-in tax benefits, which encourage you to contribute more to your account. Now, let's talk about how superannuation works. Over your working life, a portion of your pay is regularly set aside and invested into your super account. This includes superannuation guarantee contributions, which your employer is generally required to make on your behalf. To help grow your super balance, you can also make additional contributions yourself, either from your before-tax or after-tax salary. A common way to add to super is through before-tax contributions, which is called salary sacrificing. We'll explore each of these options later. So, what exactly is the superannuation guarantee rate? By law, your employer must contribute a minimum amount to your super fund. From 1 July 2025, that's at least 12% of your pre-tax salary. You generally qualify for SG contributions if you're 18 years old or over, or under 18 and working more than 30 hours a week. SG contributions are usually taxed within a super fund at a rate of 15%, which is lower than most income tax rates for Australians. Generally, all working members are eligible for SG contributions, whether you're working full-time, part-time, or casual. Contractors are usually eligible too. One exception applies to high-income earners. If you earn over $62,500 per quarter, your employer isn't required to pay SG contributions on any income over that amount. This helps you stay under the concessional contributions cap and avoid paying more tax than necessary. Did you know there's nearly $17.8 billion in lost and unclaimed super floating around in Australia? And it could include some of your money. Lost super is more common than you might think. It can happen if you've ever changed your name, moved house or changed jobs, or simply forgotten to update your details with your super fund. When your super fund can't reach you, they're required by law to send your account to the Australian Taxation Office. That's when it becomes what's called unclaimed super money. But here's the good news. Finding your lost super is actually really easy. All you need is your tax file number, and you can search the ATO's Super Match database. It will show you any super accounts in your name, even ones held by the ATO. If you're a Vanguard Super member, you can access Super Match directly through Vanguard Online or through our Vanguard app. And if you're not with us yet, no worries. You can join online in less than 10 minutes and search for Lost Super as part of the sign-up process. Just head to vanguard.com.au/super. Remember, your super is your money, so don't leave it behind. Take a few minutes today to find what's yours. One smart way to grow your super is through salary sacrifice contributions. With salary sacrifice, you choose to give up part of your before-tax salary and pay it directly into your super account. This can help you grow your super more quickly and save on taxes. Salary sacrifice contributions lower your taxable income, which can help you avoid higher tax rates. Plus, you pay just 15% tax on these contributions, which is often less than the tax you pay on your income. Another way to grow your super is through personal after-tax contributions. These can be made at any time from your after-tax income and generally don't incur additional tax when paid into your super account. If you make personal after-tax contributions, you might be eligible to claim a tax deduction, reducing the effective tax rate to 15%. To help explain this a bit more, let's meet Sandra. In February 2025, Sandra decided to start a bookkeeping business from her home office and registered as a sole trader. Sandra decided not to make regular contributions to her Vanguard Super account because she figured that as a new business, her income may be a little up and down. Towards the end of June 2025, however, Sandra's business was doing well, and she decided to make a personal after-tax contribution of $5,000 to her Vanguard Super account and claim a tax deduction for it. Sandra will need to make the personal after-tax contribution of $5,000 from her bank account using BPay and let Vanguard Super know she intends to claim a tax deduction for the contribution by completing a Notice of Intent to Claim a Tax Deduction form available in Vanguard Online. Sandra must do both of the above things before 30 June 2026. Super is designed to help you save for your future, so it's preserved or protected for much of your working life. You can start accessing your super once you reach your preservation age, which is 60 for everyone, unless you were born before the 1st of July 1964, in which case you've already reached your preservation age. And as you approach retirement, you can turn your super into regular, tax-advantaged income with a pension account. Vanguard Super offers 2 pension accounts, Transition Smart and Spend Smart, each designed to suit different stages of your retirement journey. In certain circumstances, you might be able to access your super early, such as in cases of severe financial hardship, compassionate grounds, or terminal illness. How much super you should have depends on various factors. A good place to start is to consider figures provided by the Association of Superannuation Funds of Australia, or ASFA, the peak body on all things super. Take a look at the table from ASFA and remember, the numbers are averages, so they may be too high or too low for your individual needs. You can also compare your current super balance to averages for your age and gender. This can give you an idea of whether you're on track. Let's shift gears and talk about something that's just as important as growing your super: insurance. It's a way of protecting you and your family if life were to take an unexpected turn. Insurance through super can be cost-effective and convenient, but make sure it suits your needs. Premiums are typically lower than going directly through an insurance provider and are taken out of your super account, so nothing extra comes out of your take-home pay. There are 3 main types of insurance you can access through your super fund: death cover, total and permanent disablement cover, and income protection cover. Death cover is a lump sum to your beneficiaries if you pass away or are diagnosed with a terminal illness. Total and permanent disablement cover, or TPD, is a lump sum if you become permanently disabled and can't work again. Income protection cover provides monthly payments if you're temporarily unable to work due to illness or injury. At Vanguard Super, we've partnered with AIA Australia to include death and TPD in your default cover. Income protection is optional, and you can apply for it if and when you need it. Your default insurance cover adjusts as you age, typically decreasing as you get older. This is based on the assumption that your financial responsibilities may reduce over time. Just know that at any stage, you can adjust or cancel this default cover if it's not right or your situation changes. And finally, if you already have cover through another super fund, you can choose to transfer your cover to Vanguard Super or keep it where it is. Now, let's meet Alex. Alex is 38, works in IT and has a young family. After a cycling accident, he couldn't work for 6 months. Thankfully, he had income protection through his super, which covered 75% of his salary. This helped him pay the mortgage and support his family while he recovered. Typically, there's some eligibility criteria you will need to meet to be able to access insurance cover through your super. For Vanguard Super, these include being a member of Vanguard Super, aged 18 to 65 for TPD and income protection, or under 70 for death cover, being an Australian citizen or visa holder, not have previously claimed a terminal illness or TPD benefit, and not working in a hazardous occupation for TPD and income protection. It's important that before relying on your default cover, you ask yourself, Do I work in a hazardous occupation? Have I worked at least 15 hours per week in the last 3 months? Or do I already have insurance through another super fund? If you answered yes to any of these, your eligibility or needs might be different. If you'd like to speak to someone about your specific insurance needs or what level of cover is right for you, we suggest you speak with a financial advisor. Have you ever considered what happens to your super when you die? It's a question many of us don't think about, but it's an important one. Your superannuation is your hard-earned money. And just like any other asset, it's important to decide who should receive it if something happens to you. When you pass away, your super fund may pay out a superannuation death benefit. This includes the total balance in your super account and, if you had life insurance through your super, an additional insured amount. This payment goes to your beneficiaries, the people you nominate to receive your super. You can nominate your spouse, your children, someone you share a close, supportive relationship with, or your legal personal representative, like the executor of your will as a beneficiary. Unlike other assets, your super doesn't automatically go into your will. If you don't nominate someone, the trustee of your super fund decides who gets it, based on legal guidelines. There are different types of beneficiary nominations you can make. In most cases, these are a binding nomination or a non-binding nomination. Binding nominations often expire after 3 years, unless your fund offers a non-lapsing option, which Vanguard Super does. Non-binding nominations usually don't expire, and you can update them anytime. Just log into Vanguard Online today and follow the prompts. It's important to regularly review your beneficiary nomination to ensure it reflects your current wishes and circumstances. A good rule of thumb is to check your nomination of beneficiaries whenever your personal circumstances change. The nomination that's most appropriate for you will depend on your personal circumstances, so you may want to discuss this with a financial advisor. We hope this information has helped you understand the basics of superannuation. For more information, visit our Vanguard Super Learn Centre at vanguard.com.au/super/learn or contact us directly on 1300 655 101.